All right, everyone, we'll go ahead and get started. So first off, I just want to thank everybody for joining our call today. I know you're going to get some excellent information from the presentation today, but before I get started, I just want to do a brief introduction for a couple of our presenters. To start off with, my name is Devin Rohner. I'm a financial planner out of our Brentwood, Tennessee office. I've been in the financial services industry now for 12 years, ever since I started straight out of college. I live in Nolensville, Tennessee with my wife and two boys. I've got a 3-year-old and 5-year-old little boy. So if it's not financial planning, it's baseball or Legos and race cars. So I've really enjoyed that. But our local team in Brentwood, we've got 14 advisors that help serve our clients in Middle Tennessee. We're a nationwide firm though, so we've got offices across the country. And we're a very unique setup. We have the insurance company on one side and the financial firm on another. And that's really been something that I've seen us really take advantage of, especially with our clients that are in the retirement years, just because insurance is such an important part of a financial plan. And so on the financial side, we've been able to partner with some great firms over the years, and Tom from Franklin Templeton has definitely been one of them. We've spent years together. He's been very helpful with our team out of Brentwood, and I really look forward to just hearing his presentation today and all the information that he's got. So Tom, he's the vice president, senior advisor consultant with Franklin Templeton, graduated from the University of Massachusetts Amherst with a bachelor's degree in science. He also holds a CIMA designation, and Tom's been in the business since 1994. He's been working very closely with advisors all through the Southeast United States, and spent years helping advisors on topics ranging from updates on current market conditions and also helping advisors find ways to just effectively serve our clients and help them the best way possible. So Tom lives in Nashville, Tennessee. His wife, Tiffany, and his 3 kids, Tabitha is 16, Ross 14, and Tommy's 11. So I know Tom's definitely busy outside of work as well. He spent the last 25 years, like I said, on the investment side. But one interesting fact about Tom, he's a 3rd-generation basket maker. So I've learned a lot about Tom recently too. So Tom, I'll kick things over to you just so you can take us through the material that we have today, and then we'll open things up at the end for some Q&A.
Thanks, Devin. Just making sure that you can hear me okay and the sound is fine.
Yeah, I got you. You're good.
Fantastic. I appreciate it. And thank you for inviting me today to speak to your group. It's been an interesting year. 2020 is certainly going to be one for the record books. In fact, I saw today that apparently now there's a meteor the size of the Empire State Building traveling roughly 11,000 miles an hour towards the United States, towards the world. And I know that the Locust 17-year hatch is in 2021. So it's been certainly a lot we have to reflect on to start this year. So, when you asked me to come on and speak to some of your clients and your group, the first thing that came to mind was a presentation that we put together to kind of talk about not only what's happened to set up this year, but more importantly, to put it in perspective. And so, I thought I'd just spend a quick second just to rewind and share what's been going on for the last decade. And maybe there's, a reason why all this craziness is happening now, because we do have to have resets from time to time. But, the reality is we're coming off of one of the longest bull markets on record. I've labeled it the most hated bull market of all time too, by the way, because for the past decade, it seems like everybody's been looking for an excuse for it to pull back so that they can deploy more capital. Not yet, it continues to chug northward. But we did have finally something that pulled it back significantly and swiftly, and that was this pandemic that we've been dealing with for the past few months. The important point that I like to make regarding the pandemic, and that Franklin Templeton wants you to know, is that the pandemic in and of itself is a global challenge, and it has significant consequences from a health perspective. But it was the reaction of governments and states that created this sell-off. And the reality is there was no good answer. Whether you took Sweden's route, or, on one extreme and tried to reach herd immunity, or you were a totalitarian country and literally shut it down, or you were somewhere in between. But we believe that it's this concept of this unloved bull market that really caused this swift sell-off. It was the excuse everybody was looking for. It was the catalyst. And so as you see the timeline, one of the things that we do applaud the Fed with was the swiftness by which it reacted. And not to say that won't have long-term consequences, and that's something we continue to deal with. And it is the great unknown, and it dates back to the Fed 2008 and 2000, which frankly happened well. For a perfect answer, it's what's the best that they can do. And when we fast forward to today, we're going to learn. We when I say we, powers to be, are learning what is going to be appropriate when we do have to deal with this, perhaps in the winter, if COVID were to spring back up. So a lot of lessons have been learned, and we'll take what was done right and probably do some more of it, and what was done wrong and try to learn from it and change. So I guess the setup here is that we're in a secular bull market. We do believe that. But when you do get these bear market sell-offs, there's a catalyst involved, and this was clearly the catalyst for what was a very swift bear market. So with that being said, I wanted to put in perspective what bear markets, while they're difficult to deal with when we're going through them, what they look like in relation to not only their historical counterparts, but also the bull market that ensues. I also wanted to spend a minute on a couple important behavioral biases that we all have as humans, or tendencies, and their impact that they have on the investment decision-making process of a human. And lastly, I'm going to share with you a few common sense investment basics, if you will, building blocks for success that everybody should know. And most of you, I'm sure most of you know them. So if you do, they're really important to be reminded of. And if in fact it is something that's new, it is definitely something worth remembering. So with that being said, let's get into it real quick, and let's take a quick historical perspective when it comes to bear markets. If you go back 50 years, here they are in front of you. When you're going through a bear market, they are terrible, right? They're scary, feel like there's no end in sight. And it seems like the more advanced we get as a society and the more information we have at our fingertips, it seems like you can't even escape them. It's almost suffocating. But the reality is, when you look at them from a length and a depth perspective, they pale in comparison to the following bull market. Because while you see the negative declines, you then see the positive returns following a bear market. Remember, the end of a bear market is the beginning of the next bull market. And so we always like to put that in perspective for folks. Now, when you look at, and by the way, just as a reminder, this isn't the first epidemic that we've had to deal with recently. You've got SARS that occurred in 2003, the swine flu in 2009, fast forward to Ebola, which actually happened twice, but it didn't register the second time because there was a vaccine, and the procedures to go ahead and isolate it were put in place from the lessons they had learned the original time this happened. And by the way, there was a case of it recently in the Congo within the last week as well. You probably won't read anything about it because, again, we learn lessons. We take those lessons and then we apply them. We're very good at that. So if this is not new, what's interesting about the past epidemics since 2000 is that when you look at them and you look at the reaction to local equity markets in those countries, we use this term peak interest. If you're not familiar with it, peak interest is that point in time where you've got a global issue that's receiving a lot of media attention. Peak interest is the day that it receives the most mentions in the media. And when you look at an epidemic and the performance of the local market from peak interest, the up until peak interest, there's typically a sell-off of a high single digits, but then the recovery within 1 month is high single digit, and within 3 months is double digit. Now, obviously, COVID's decline was a peak to trough, roughly 31% decline. But we're following that same pattern post peak interest in terms of the recovery. And so again, and just to be clear, COVID it was the excuse, it was the catalyst. And it'll be interesting to see how this all plays out and how effective the Fed action was in the short term. So that's just kind of a quick historical perspective. Now let's take a look for a few minutes and focus on a couple investor biases. These are, emotions. We're humans, right? The good news is, what makes us human, it's emotions, our ability to have emotions, and opposable thumbs, I guess. But when it comes to investor bias or biases, it's important to understand where they come from. So I'm going to show you two parts of the brain. The first is the frontal cortex. The frontal cortex is responsible for rational thought. Think of it like the good angel on your right shoulder. And the amygdala is a small little part of your brain in the middle, and it's responsible for emotional reaction. Think of it like the little red devil on your left shoulder, right? If it's the classic example when you open up a refrigerator and there's a piece of chocolate cake and a salad. The amygdala is telling you to eat the chocolate cake because it tastes yummy. Don't worry about it. You can go to the gym later. That's what it's saying. And the frontal cortex is saying, no, it's not good for you. Eat your salad. You're going to feel better. It's better for your health, etc. The reality is, though, that media knows that. And when you look at, if you were to watch CNBC, if you turn on Bloomberg or CNBC today, you would notice multiple scrolling screens across the bottom of your television or across your computer, and then pop-up boxes with urgent, breaking news. And they're color-coded, red or green. And the whole point is they're trying to create a response from you, an emotional response. They're masters at it. And they're trying to tap into what your amygdala does. And that's not helpful when it comes to creating a successful investment strategy. They're working against you. So I wanted to point out two biases today you might want to be aware of, because they can affect your decision making when it comes to investment success and hinder it. The first is anchoring. Anchoring is focusing on one data point to base a relationship or a more complex issue on. Not looking at all the facts, just focusing on one simple thing. And we can see it manifest itself when it comes to a relationship with an investor and a professional investment advisor. So I'll use this example. If I would put 100 people in a room and ask everyone one question: what's the average return of the S&P for the past 30 years? The answer would be 8%. That's what the majority of people out there peg the average annual return of the S&P at. And in their head, this is the graph they would expect. This is the ride they would expect from the S&P. A smooth 8% every year return, compounded on itself. And if you want to turn that into dollars, a $10,000 investment at the end of 89, fast forwarding to the end of 19, would have returned tenfold $100,000. Now here's the actual return of the S&P. It's a little higher. It's at 10% per year. But a couple percentage points, as you well know, makes a big difference in dollar amount. So that 10,000 grew to 172. But I want to set up this scenario on how anchoring can impact a relationship with an investor and a professional investment advisor. So at the end of 2000, that $10,000 account was worth $52,000. And everything was great. Hardly any phone calls occurred between then and when you put the money in. However, but by 2002, by March of 02, that $52,000 account was now a $36,000 account. And you called your advisor upset because they had lost you over $16,000. But what's interesting about that phone call is there were very different views. The investor's mad and upset because they've lost $16,000. The professional investment advisor is sitting there going, no, I've made you $26,000. So in just over 10 years, I've more than doubled your account. That is anchoring. What's even more curious is that while you were worth more money while making that phone call than you would have been owning that hypothetical 8% average annual return. And by the way, your advisor would have been the greatest person on the earth. So it's a really interesting bias that we have to not only be aware of, really be aware of, so that you can check yourself when those emotions enter your brain, because they will. I mean, that's part of what makes us human. So anchoring is a tough one. An even harder one, I think it's a far more damaging one, is loss aversion. I use the example, if anybody's seen the Jimmy Kimmel skit where they have parents videotape the child's reaction the morning after Halloween when they pretend that they've eaten all their kids' candy, and you see the kids freak out. If you've ever seen that, you'll know that's loss aversion. It's basically an emotional bias where we feel the pain. The feeling pain is greater than the reward of the same amount. So a unit of loss hurts us more than a unit of gain. Where it becomes a problem is in these mass sell-offs. So that the capitulation phase of a bear market, whether it was 2002 or 07 to 09, when investors pulled out on a net basis over $500 billion out of the equity markets in the dot-com bust, and almost $1 trillion during the global financial crisis. And see, that's not the problem. The problem is then when you do make a panic sell decision, you then have to do something with it. In this case, you don't want to lose anymore, and you're afraid. And so you find yourself going to safe investments in order to protect what's left. And this is where investors went. They went to money markets, short-term savings and short-term CDs, checking accounts. And on their statement, they stopped the loss. They felt better. Unfortunately, that's not your actual return. That's just your nominal return. You need to understand what your real return is, which is your return minus inflation. And when you calculate inflation into the equation, the travesty in all of this is that investors continued to lose purchasing power. So not only did they capitulate at the worst possible time, but they then proceeded to compound the problem by going into an investment that no longer provided a return that outpaced inflation. And sadly, a lot of those investors are still in those short-term savings vehicles today. And so that's a tough one. And it really does manifest itself during the low points, if you will, of the bear market. And frankly, typically capitulation sets up the next bull market. So let's get on to something more positive. Let's talk about some ways that you can navigate these uncharted waters, ways that you can stay the course, if you will, or at least have a better perspective, have a more broad perspective to kind of weed out some of the noise. And the first thing is stay calm. So I work for Franklin Templeton. We're a global firm. And in about a month, when we complete our transaction with Legg Mason, which we purchased in June, or not the spring, we'll be a $1.5 trillion company. We actually have over 42 offices around the world in, I believe it's 36 countries now. So, one of the founders of the Franklin Templeton arm, the founder actually of Templeton is a gentleman named Sir John Templeton. And he published in the Christian Science Chronicle, he called it his 16 rules for investment success. And one of them in there is before he makes a decision to buy or sell, he says a quick prayer. And it's really just to steady himself, to make sure his mind is clear. So number one, stay calm. Try to figure out where the noise is coming from before you make a decision. And number two, keep a long-term perspective. I'm often consulting with advisors, helping them figure out what might be the right allocation based on certain goals or a particular investment and how it works. And often there's more than one answer. And so what my ultimate answer is falls back on this basic question. Which of these options would an investor have the best chance of holding the longest? Because the longer you hold on to a high quality investment, the odds of you having investment success go up. And this is a good example of it. This is just the S&P. And I like to call this chart the market climbs the wall of worry chart, because there's always going to be a reason not to invest. There's always going to be something that'll stop you from saying, yes, I'm ready. But markets continue to march on regardless of the obstacles that are in front of them. They do take steps back from time to time. Absolutely, that's normal. But again, the longer your perspective, the better your odds of success. And I think this chart really, really illustrates it well. So let's look at the last 50 years. If you were to, and I'm going to use the daily number to start with, if you were to day trade, basically buying the S&P on the open and selling it at the close every day for 50 years, by the way, that's a little over 13,000 trading days. The odds of you making money are slightly better than 50-50. But if you expand that time frame out to 1 month, they almost go to 2-to-1. Go out to 1 year, 4-to-1. And as your time period increases, the odds of you having investment success increase. I think this is a great way to illustrate the point of having a longer term time frame. Of course, we've all heard the phrase, don't put all your eggs in one basket. Diversification does matter. Investors cannot time the market consistently time and time again. This is a chart, they call it the Callan chart, the jelly bean chart, there's other names for it, but it shows you, going back to 2005 in this case, all the major asset classes and their performance in that calendar year, putting the best on top, the worst on the bottom, and color coding them so you can kind of see the pattern. And the reality is that there really isn't a pattern. You can't just buy the winners and expect them to continue, and you certainly can't profit from only buying the losers. And if you want proof, here are the numbers. In fact, for the past 20 years, if you put 10,000 in a year and only chase the winners, bought the last year's best performing asset class, the value of your portfolio would go from 200 to 438, or roughly a 7% average annual return. If you're contrarian and you buy the losers, it's slightly less at 416,000. But if you were to actually put equal amounts in all of the asset classes every year, your average annual return is the best. Let's talk about strategy. You're on this call because you are associated with or know a professional investment advisor with Bankers Life that asked you to spend a few minutes and hear our message. What's the best way to navigate volatile market periods? It's to not have to worry about what your statement reads on a quarterly basis. Instead, our recommendation at Franklin Templeton is working with a professional investment advisor and having a plan in place, a financial plan where you've stated your goals and your needs and you've structured a way to achieve those. And if you have that, it's no longer about what your quarterly statement says or your monthly statement. It's about, am I still on track to meet those goals? Because if you are, then you're fine. And if you're not, then it's important to, number one, reevaluate those goals and make sure they're realistic. And two, make the appropriate changes as soon as possible. That gives you more time to overcome that particular challenge. And if you want a chart to show you kind of why that's important, it's because, going back to 1988, in any particular year, there was a point in time where the market pulled back and you were down, worth less than what a previous month or a previous quarter's value was. And that's referenced or illustrated by the blue bar, right? If you want to give you a specific example, look at 1998. At one point in time, you were down 19% from the high that year. Had you stayed in, the green bar tells you what the calendar year finished up. And in this case, it was up 29%. Having a financial plan that is an ongoing living, breathing document helps avoid the pitfalls that tend to show themselves up with volatility in pretty much any given year. Now, whether you're in the accumulation phase or you've accumulated what you have, and now you're trying to grow it, dollar cost averaging is a fantastic strategy. If you participated in any kind of a retirement plan throughout your working career, you dollar cost averaged. You took a certain set amount of money every 2 weeks or every month or every week, and you bought a certain number of shares based on the price. It's a great way to accumulate shares at a lower average cost, because in this example is a perfect example of it. For 6 months, you put in $500, so it's a set amount. The share price fluctuates. Sometimes it's 12, sometimes it's 9. And therefore, you're going to buy less shares when the price is high, and you're going to buy more when the price is lower. And what you end up with is the average share price was $10 a share, but your average cost was only $9.77. And so you saved 23 cents per share. Now compound that, or run that scenario out for 10 or 15 years, and you can see why it's so effective. The other way you could do it is by reinvesting dividends. Right? If you own investments that pay a monthly or quarterly dividend, and you then reinvest it and buy more shares, that's also another way to dollar cost average. Now, lastly, I'm going to finish up with one of the big ones. This is the one we deal with most, and it's the desire for people to time the market. Right? How many times have you heard somebody say, or have you thought to yourself, "Gosh, if I'd only gotten out then, and then I'll get out, and then I'll just get back in when things get better." Well, let's look at the cost of jumping in and out. So in this case, I'm going back 20 years through March 31st. And by the way, this encompasses, in the last 20 years, we've had 3 bear markets. So this number looks a little bit lower. But the S&P for 20 years has averaged 4.85%. If you were to miss the 10 best days, your return is just shy of 1% per year. And just to put some math behind it, in 20 years, there are roughly 5,200 trading days. So if you just miss the best 10, your return goes from just under 5% to just under 1% per year. Extend it out to 20 best days, and you've averaged a negative return of 1.7% per year. 30 days, it gets worse. And here's why. Often the best day in the market follows one of the worst. And I'm going to match them up for you real quick. And you can see very quickly, most people miss some of the best days because they get out after one of the worst. So it's actually, unfortunately, a very common phenomenon. So just remember, in historical terms, bear markets, while challenging and tough, aren't as bad or long in the grand scheme of things when you contrast them to the following bull market. Be wary of your emotions. Another great advantage of having a professional investment advisor attached to your account is that sometimes one of the best things they can do is help manage your expectations, help talk you through those periods of time where you're feeling like maybe I can't handle a loss, or it's going to get worse, or this time it's different. Believe your beliefs, doubt your doubts. And lastly, remember some of these common basic strategies that you can use to go ahead and navigate these uncharted waters, like dollar cost averaging and diversification and having a plan. And most importantly, please don't try to time the market. I'm going to stop it there, turn it back over to Devin, and I'm happy to answer any questions that y'all might have. I appreciate you spending some time today and listening to Franklin Templeton's message.
Yeah, thanks, Tom. Great stuff as always. There's always something new that jumps out, but one of the things that I caught this time was just like always, just the importance of having a financial plan set up properly on the front end. It's excess of anything is bad for you to a certain extent, and it's just making sure you've got balance with your money that's in the market. And the slide that you talked about where people flee to safety and leave it in money market accounts and how just inflation eats it up. There's a lot to be said for having a plan for your safe money too. So that's good stuff. I do have a couple questions that I want to ask you just to kind of kick off the conversation, and then we can have anybody else chime in with questions too. But just the first one, going back to that slide that had the max drawdown and then where the year finished. I think this year the S&P, like you mentioned, was down about 31% at one point. And I think as of yesterday, we're still down about 3.5%, but still that's a pretty big bounce back. Have we ever seen that big of a drop and then recovery in the history of the market?
No, we haven't. I was thinking about that actually, because I saw a chart the other day. I think it was 2 days ago, and I wish I had saved it. But magnitude of peak to trough drop, and now the subsequent recovery. This is the fastest. The next closest was the in 1998, we had long-term capital management implode. And that was the next, the next biggest.
Wow. Yeah, I think that just reinforces, how having a balanced plan to start with, will help you weather those times, because you could have missed out easily on some big days just in this drop this year.
Yeah, if you want to illustrate that point, Devin, here it is right here, 316, down 12, and then one of the top recoveries on 317.
Right.
313, and then actually 326 were three of the biggest days.
Yeah,
oh, and 310.
Yeah, those are big. I guess this kind of goes along the same lines, but I hear this a lot from clients, and especially this year when you add in everything that's happened with COVID and just everything else that we're seeing on the media happening right now. But it's also, you got election years that people worry about. What have we seen over history with election years? And what advice do you typically give advisors or clients?
Election year is the tough one for me to answer, in the sense that people don't like our answer, but unfortunately it's just the way it is. So, number one, when you look at stock market performance in the broader U.S. indices, the worst combination is when you have one party controlling the Senate, the House, and the White House, the executive branch. So when you have one party, regardless, Democrat or Republican, controlling everything, that tends to be both the worst for broader market indices. And so having it split is helpful this time around. And also the other thing is, had Bernie Sanders won the Democratic nomination, and we think this market would have really had some challenges, because you then would have had two candidates that were diametrically opposed when it comes to their philosophies. But since Biden won, they're a lot more similar, at least from a capital market standpoint. And so we don't think that's the election will be one of the reasons why the market sells off.
Gotcha. That makes sense. Another question, and this is kind of geared towards, a lot of our clients, especially, or, in their retirement years, and conversations always come up around, you get to retirement, it's about that distribution phase of your financial life and generating income. And we're seeing that retirees today are facing a much different challenge than previous generations, trying to generate income because of low interest rate environments and things like that. What do you see? What do you recommend? What are you hearing around just how retirees are in just such a different time right now to generate income in our economy?
Yeah, it's something that we spend a lot of time talking about at Franklin Templeton, right? You've got this giant experiment that the Fed has undergone, really started in 08, 09. And, part of this, recovering from the Great Recession, and now of hoping to avoid another one, has been to create all the stimulus. And part of that is obviously to depress savings rates, and what has followed is fixed income rates. And really, retirees and investors have relied on income from fixed income investments for the past, up until about 2011, for the previous 30 years. But don't forget that back in the 60s and even into the 70s, investors, retirees relied, number one, they had pensions, but number two, if they didn't, or to supplement, it was investment income from equities. And right now, when you look at the yield on the S&P versus the yield on the 10-year, the yield on the S&P is far more compelling. And historically speaking, when that happens, equities tend to generate better returns. We're seeing a shift. Retirees are definitely drawing more income from equities than they were in the past. And it's, part of it's the Fed is kind of forcing people into more risk assets.
Yeah, no, we're definitely seeing that. And, to me, that just also, speaks to a lot of just the financial planning profession. And I think it puts us in a position of even greater need today than it was back in years where that wasn't the case, and fixed income assets generated a sufficient income for retirees. So looking at some positives, I mean, what are some of the opportunities that the fund managers you talk to daily are seeing right now, and just give us some positive light on the opportunities right now in the market.
Sure. So one of the overarching themes at Franklin Templeton is that we have a set of managers that believe very strongly that we're in kind of another industrialized revolution period of time, but it's more a technological revolution. I mean, just look at what kind of industries have been created in the last 10 years, and really, we think COVID almost has fast tracked some of them, or at least increased the likelihood that they will not only be viable industries but will prosper and grow. Take a look at areas such as gene therapy, or robotics, AI, green energy, alternative energy. The ability to communicate. We're sitting here in the middle of the day and talking with a large group of people, communicating online. Normally this would be done in person, and everybody's okay with it. So, we believe very strongly when you look out over the next few generations, our lives are going to be dramatically impacted by all the new technological advances that are coming down the pipe. Take gene therapy for an example. It's the ability. If you go back 10, 12 years ago, it took a couple $1 billion in 4 countries to map the first gene. And now it's already being applied by companies to go ahead and treat what were once extremely hard and diseases to cure that were terminal. And now you look at all the resources that are being put into place to use the concept of gene therapy to battle and create a vaccine for COVID. That's going to fast track that. Look at telemedicine. Telemedicine was in its infancy, and because of the inability for people to travel and not want to go to a doctor's office for the past few months, it's been a springboard for that industry. And robotics. All sorts of different industries are being created, and it's so really, if you just take a step back and I would say, ironically, stop looking at your phone for a second, look around and really think about what's happening. We believe very strongly that life will be much better for generations to come because of all the new technological advances that are out there. So that's one thing we're very excited about. And then the second thing is there have been industries that have been, because of the benefit and the kind of the buzz around a lot of these names and companies, some really good names that would be considered more old world have been hit pretty hard and punished. And a lot of those companies are going to adapt. Not all of them. Some unfortunately will not make it. But a lot of those will adapt and get better and stronger and employ some of the new technology that's out there. But right now they're trading at a pretty healthy discount. So, to own equities, the reality is you do have to be optimistic. But that's a pretty powerful message that I think is hard to ignore if you really think about it.
No, that's good. That's good stuff. And I guess just to end with, it's it is more of a statement than a question, and you can support or debate it. But I think just the financial planning profession in general, I think we are in as great of a time as ever to really step forward and prove our worth and our value to our clients, just because of all of the challenges that they face in the markets and with interest rate environments, and especially retirees trying to generate income. I think we're in such a great position to really step up to the plate and prove our worth to our clients. So, if you got any other thoughts on that, we'd love to hear them. Otherwise, we'll step forward to answering any questions from the group that might be here.
Devin, my last statement would be regarding what you just said is that, we believe at Franklin Templeton, well, number one, you can't buy an investment through Franklin Templeton unless it comes through the advice of a professional financial advisor. It's because we believe that if you're going to invest, you should have professional investment advice accompany it. But more importantly, and this is just my perspective, my personal view, is that an advisor, I believe, is worth their fee, will earn their fee 10 times over through the course of a relationship with an investor. It's not something you can quantify in the front end, but again, dealing for 25 years with thousands of advisors, I've seen it time and time again where over the course of a long relationship, there is a point in time when an advisor can look back on that relationship and point to an event, something they might have done that might have seemed very benign at one point in time that ultimately helped that client. And if you were to put a price on it, it's again far greater than the fee that the client ultimately paid.
I would agree. All right, Tom, it looks good. I think we've covered most everything. So, again, thank you, Tom, so much for just coming on today, sharing all this information. We appreciate what you and Franklin Templeton have done for us over the years, and we look forward to many more good years ahead. So thanks, everybody, for joining the call. Be well, be safe, and we'll see you next time.
Well, thank you for having me on, Devin. Hope everybody has a great week. Take care.